Welcome to this explainer. Today, we're diving deep into the hidden language of the markets. We're talking about algorithmic price delivery and, specifically, decoding fair value gaps. You know, those literal price gaps created by just absolute raw momentum. We'll look at why markets so consistently revisit these very specific areas before continuing on their trajectory.
So let's kick things off with a scenario we've all run into. What exactly happens when market momentum moves way faster than buyers and sellers can actually react? If you've ever felt the sting of getting chopped up in a volatile, fast-moving market, you know the exact pain I'm talking about. But what if all that chaos is actually leaving behind a perfect, readable trail? Today, we're hunting for those smart money footprints.
Here's our roadmap for today. First, the anatomy of market imbalance. Second, decoding fair value gaps. Third, the search for liquidity. Fourth, inversion fair value gaps. Fifth, the balanced price range. And finally, number 6, trading the FVG.
All right, Section 1, Anatomy of Market Imbalance. To really grasp the gap, we've got to understand the environment that creates it in the first place, right? When we talk about an imbalance or a liquidity void, what we're really looking at is a broad zone of pricing inefficiency. This happens when there's a sudden, aggressive expansion in one direction, a major displacement. Price moves so violently that the buying or selling pressure just completely overwhelms any available limit orders. It becomes a one-way street. You'll usually see this void spanning multiple large-bodied candles with these tiny little wicks, which basically tells us price moved way too fast for any two-sided, balanced participation. But what actually triggers this kind of massive displacement? Well, there are 4 main culprits: high-impact news shocks, massive institutional flow coming in, sudden sentiment shifts, and cascading technical triggers, like massive stop runs. Literally, any of these forces can violently skew the order book. They just consume all the resting liquidity and leave this huge, gaping void right there on your chart.
Moving into Section 2, decoding fair value gaps. Okay, so let's take this broad concept of a liquidity void and drill down into something we can actually measure. While a liquidity void is this wide area of inefficiency, a fair value gap, or FVG, lives specifically inside that void. It's a highly structured, mathematically precise representation of the imbalance, and it's defined by a very rigid 3-candle sequence. Take a look at this foundational 3-candle formation. The FVG is literally the physical, unfilled price space between the wick of the first candle and the wick of the third candle. And that middle candle, that is your aggressive displacement. Because the wicks of candle 1 and 3 completely fail to overlap, they leave an absolute void of trading activity in that middle range. That empty space right there, that's our fair value gap. Now, an absolutely crucial point here is that FVGs basically come in 2 distinct flavors. First, we have the BSI, buy-side imbalance, sell-side inefficiency. This is your bullish FVG. Buyers rushed in, left the sell-side orders unfulfilled, and it ultimately acts as structural support. On the exact flip side, we have the SIBI, sell-side imbalance, buy-side inefficiency. This is a bearish FVG driven by dominant selling. It leaves buy-side orders hanging, and it ends up acting as a resistance zone. Up next, Section 3, the search for liquidity. So now that we know exactly what they look like, the million-dollar question: why does the market almost always return to these gaps? Our sources describe the market algorithm as having a literal breathing pattern. Think about it like this. The market exhales by pushing outward, seeking and destroying external range liquidity. You know, those resting stop losses sitting above swing highs or below swing lows. But that aggressive exhale leaves behind internal range liquidity, the fair value gaps. So to inhale, the market has to retrace back into those gaps to rebalance the ledger. It's drawn right back to these low impedance zones simply because there's no historical order friction stopping it. But here's the thing. Quantitative studies show that not all gaps are created equal. The actual velocity of an FVG dictates if it's going to hold. A true imbalance forms with a flatter, slower slope. We're talking less than or equal to 0.00015 price units per second. That indicates real, sustained institutional accumulation systematically consuming the order book. When price returns, institutions defend it. A false imbalance, on the other hand, is steep and frantic, greater than 0.0004 units per second. That's usually just a stop hunt or a sudden news spike with zero real institutional commitment behind it. Retest on those steep gaps, they fail all the time. Moving on to Section 4, Inversion Fair Value Gaps. So, what exactly happens when that algorithmic delivery breaks down and a true FVG completely fails? Well, the earliest warning sign of a weakening trend is when price flat out disrespects an existing FVG. It plays out in a few steps. Step 1, an FVG is established. Let's say it's a bearish resistance zone. Step 2, price violently violates it, displacing straight through and closing right past the gap's boundary. Step 3, we get a polarity shift. The whole gap inverts. What was meant to be bearish resistance instantly flips to bullish support. We call this an inversion fair value gap, or IFVG, and it is absolutely your first major clue of momentum fatigue. If you look at the price action in this live example, you can see these large displacement candles just leaving FVGs in their wake. It's a really great reminder that sure, spotting the gap visually is easy, but you have to have structural context. We don't just blindly trade every single gap we see, right? We have to watch how price actually behaves when it returns to these zones. Does it respect the gap, or does it slice right through to create an inversion?
Section 5, the balanced price range.
Now let's look at how these concepts stack together to form one of the most highly advanced structural states you can find on a chart, the balanced price range, or BPR. A BPR is created by extreme dual-sided volatility. Price expands aggressively in one direction, leaving a fair value gap. Then, almost immediately, it reverses with equal or even greater force, slicing straight back through the initial gap and leaving a counter-directional gap right on top of it. The BPR is that exact horizontal overlap of those two opposing gaps. It basically represents a total double clearance of efficient price delivery. Because both buy-side and sell-side imbalances have been fully resolved in such rapid succession, a BPR acts as an exceptionally sensitive line in the sand. Unlike a normal gap where price might retrace deeply into the middle, algorithmic repricing often targets only the absolute outer edge of a BPR. It just taps that overlapping zone and experiences an immediate, explosive rejection. Honestly, it's one of the cleanest execution zones in modern price action theory. Finally, Section 6, trading the FVG. Okay, let's ground all this theory into reality. How do we actually execute? Well, sometimes an opening gap or a breakaway gap doesn't get filled immediately. If an FVG is left completely open in a heavily trending market, it acts like pure rocket fuel. It tells you the algorithm is in an extreme hurry to hit external liquidity, and trader hesitancy means absolutely no one is willing to step in and fill that gap. Recognizing a breakaway gap is a total game changer. It keeps you from sitting on your hands waiting for a deep pullback that frankly just isn't coming. But when a retracement does happen, here is your execution playbook. First, watch the consequent encroachment. That's just a fancy term for the exact 50% midpoint of the FVG. Valid rejections will often pierce the gap, but close precisely at or below this midpoint. Also, keep a close eye on new week opening gaps and new day opening gaps. These historical gaps act as highly reliable algorithmic anchor points, especially when the overall market is just chopping around in consolidation. So we've covered the whole shebang, the anatomy of displacement, the strict geometry of fair value gaps, algorithmic breathing patterns, inversions, and balanced price ranges. The market algorithm literally leaves its footprints right there in the gaps, plain as day, if you just know how to read them. So I have to ask, after seeing all of this, are you ever going to look at a blank space on a chart the exact same way again? Thank you so much for joining me for this explainer, and hey, happy hunting out there.